Hello everyone. In the 12th episode of the Lab Look Back, I am going to take you through two things. I am going to answer should you invest in the US markets in 2026, and I am going to take you through everything that happened in the Indian markets in the last 7 days, that is the last week. I am going to tell you how is the market health, where is the momentum right now, and which themes are leading in this market. For the US markets, I am going to take you through a very important data point that will answer your query as to when is the best time to invest in the US. So let's get started with the first part, US markets. The first thing that I'm going to take you through is called the Buffett Indicator. The Buffett Indicator, named after the famous Warren Buffett, is the ratio of corporate equities in the US, that is the corporate US shares market cap divided by the gross domestic product, that is the GDP or the economy of the US. So it is the listed corporate equities divided by the GDP of the US. You will see that this ratio, this is the median line of this ratio, that is a center point of this ratio, and this ratio keeps oscillating above and below this line. Right now this ratio sits at a 230%. That is way above the center line. The center line is about at 150, as you can see, and we are currently sitting at 230. 230 is way higher where the ratio should be, and there is a possibility that we can come back from here. In the past, when the ratio has stayed above the median for a long period of time, we have seen that the US has given a period of underperformance after that. And you can see that whenever this ratio extends a lot from the center line over here, and over here, we see a soon fall back into the ratio like this. So that means that this ratio is cyclical, and with time it goes up, it spends some time down, spends some time up, spends some time down, and lately it has spent a lot of time up without coming down from this trend. You can also correctly identify the periods of the higher percentage. This is 1970, after which US had a lost decade. This is 2000s, before the dot-com bust. This is 2008, before the global financial crisis. This is 2020, before the 2020 COVID-19 correction. And this is 2026, where the AI boom is leading the market. So this is the state of the current indicator, and currently it is trading much above the center line. Now you will say, Saksham, this indicator is trending upwards, right? This indicator is already trending upwards and the mean is also gone up. So that means we are at the right price, correct? No. I'm going to take you through a detrended version of this ratio. That is, we will remove the trend from this ratio and then see where the markets are right now. This is the detrended version of the Buffett indicator. Detrended, and then we are seeing the standard deviations above and below. So using statistics, we have removed the trend from this ratio. We have taken all this data from VTF advisors. They have a presentation on it. So this ratio is going above and below the detrended regression center line. The regression center line is the mean of this trend, and currently we are seeing that we are 64.7% above the detrended regression mean. And in the past, every time this has happened, we have seen a pullback and a period of underperformance in the US markets. Instead of using corporate equities like the Buffett indicator, some people prefer to use the Wilshire 5000 index divided by GDP. What it does is that Wilshire 5000 is the broadest stock market index to exist, and it gives a broad idea of where are the US market caps situated right now. So going to the Wilshire 5000 to GDP ratio, over here also you can see that the trend is specifically upwards, and currently we are sitting at 3 standard deviations above the mean. Alright, so 3 standard deviations above the mean is not normal, and we are bound to come back in some way or the other. Even if we take a detrended version, we can see that there is some cyclicity over here, and this should come back, and there might be a period of some elongated underperformance of the US markets. When this will happen, we do not know, but when the ratio is topping out, when the ratio is over here, which is so far over here, at this point, it does not make sense to take fresh equity exposure into the US markets. Now let me take you through the Indian markets and what happened in India in the last 7 days. Where are the sector leaders, where is momentum, and how is the market health? We will go to wealthlab.in, and on wealthlab we will go to weekly recap. On weekly recap, we can see that we have the data from the past 7 days as to what has happened. We'll talk about 3 things: the breadth, the momentum sectors, and the themes that are leading in the current market. So let's talk about the health or the breadth of the market. The market went down by 2.5% and the rotational signal is still signaling towards small and mid. That means we are still signaling towards if we should be favoring small and mid caps or mega and large caps. Let's see how is the trend of this rotational signal over time. Let's go down to rotation signal, and we are seeing that there is some correction coming into this rotation signal. That is, it has peaked from 1st April, it has just gone up and now it is coming down. When the signal is below the white dotted line, that means we have to favor large caps. When it is above, we favor the small and mid caps. So the ratio is currently retreating. That means some risk on sentiment is going away from the market. Then we will see that the breadth snapshot, that is the amount of stocks that are above their 200-day moving average, 100-day moving average and 50-day moving average. Until last week, we had a 83% Indian equities that were trading above their 50-day moving average. That is more than 4/5 of the market. More than 4 stocks out of every 5 stocks were trading above their 50-day, and this was a very bullish sign, but bullish so much that it cannot be sustained. And the last week also I said that there should be a healthy correction for the leaders to emerge. So this has come down to 68.21% in a healthy manner. Percentage above 100-day moving average has also come down from 65 to 50%, and percentage above 200-day moving average has come down from 51 to 41% in the last 7 days. That is 2.5% correction of the market. This seems to be healthy because in the last 1 month almost everything went up and the leaders did not emerge. It was more of a dead cat bounce where all the stocks went up together, a short squeeze of sorts. Now after this correction, all of the stocks might not go up, and we might see strength in selective pockets of stocks that will go up from here. And that is how leaders emerge in new bull markets. Talking of leaders, let's go to the industries where most stage 2 stocks, that is momentum stocks, have emerged in the last week. So we'll go to the stage 2 pipeline and we'll expand this, and we'll see that a lot of sectors has +1, that is one stock has added stage 2 again in these sectors. Let's see the total percentage of stocks. Over here we can see that steel is seeing 11 out of 26 stocks. About 40% of steel stocks are in momentum right now. This is one thing that should be marked. NBFC, 30% of NBFC, 30% of NBFCs are in stage 2 right now. Apart from that, metals are in stage 2, although these are cyclical and they have been having their rally since August, September of 2025. Power is also in stage 2 with 25% of its stocks, right? So this is how the stage 2 momentum looks like. We are seeing steel, we are seeing NBFC, we are seeing some metals which are in bull run since a while, and we are also seeing power, which is now retreating in terms of stage 2. In the past 3 weeks, we saw a lot of strength coming into power sector. Now in terms of stocks, we will see that all of these stocks, about 31 stocks have entered stage 2 in the last 1 week, and you can track all of them on Wealth Lab. Now let's talk about the themes that did not go down when the market went down last week. The themes with good relative strength. So I'll take you through sector rotation and we'll expand this. We will see that defense has dropped. We have been saying since couple of weeks that defense has been losing steam, and this is a late stage cycle. Steel has gained a lot of strength and is now number 1, defeating defense after a very long period of time. Apart from this, we are seeing mining and mineral coming back into strength. Healthcare theme is coming back into strength, and telecoms are coming back into strength with companies like Airtel, Indus Tower, etc. gaining strength in this current market. So when the market went down, we saw telecoms, we saw healthcare, we saw metal and mining, we saw steel that did not go down and currently have strength. This is where the money is moving. Now in terms of sectors that did lose strength, we have power. This is not a big indication or something to worry about, because over the past 4 weeks, power has gained a lot of strength, and now it is only fair that powers and wire and cable retreat a bit, see some profit booking, and from there you will have to see if it is again going to gain some strength. In recycling, we saw some strength gain last week, but this week the recycling sector has again given up everything that it had gained. Energy is sitting flat over there. Railways and BFSI are what is something that are moving in terms of stage 2 as well, and in terms of sector theme rotation as well. Steel is also one of those names, and BFSI is also one of those names. We will see that contract manufacturing has lost a lot of strength and textiles have lost a lot of strength. Jewelry is also one sector with the infamous announcement that was made last week. Education has lost some strength into this market. These are the 5 stocks that gained the most relative strength in the past 1 week. On our Twitter handle on Wealth Lab, we had posted the key drivers or the key catalyst in all of these 5 and the reason why you should or should not watch out for them. In this video, we spoke about if this is the right time to invest in the US markets, provided all the data and all the narrative that there is, and everyone that is rushing to invest there. We spoke about how the pullback in the Indian markets is healthy and leaders might emerge from here. We spoke about which sectors are leading in the stage 2, that is momentum in the current cycle, and where is the leadership in terms of themes, where we spoke about steel, defense losing momentum. We spoke about how pharma and NBFCs are gaining strength. Our current stance at Wealth Lab after this correction is positive, and we think that a new bull market might emerge, but the bull market will continue to stay selective. That is, it might not be very broad, and quality names might lead this. If you like this analysis and if you like what we are doing at Wealth Lab, subscribe us below. If there's any question, leave it in the comment section and we'll answer for you. See you next week.